it's interesting because we talk about this a lot, Dr. Pfau, and people many times don't transition well from that accumulation phase where they're trying to focus on return on investment to making sure their money lasts throughout retirement. Talk a little bit to us, if you would, about this 4% rule and where we are today.
Well, the 4% rule came about in the 1990s. There was an advisor in California, William Bengen, who was responding to a lot of the really incorrect type of assumptions being made. That, for example, historically, stocks would grow at about 7% after inflation on average, but you can't just plug a 7% return into a spreadsheet and assume you're going to be able to withdraw 7% or even 8% if you want to let your wealth dwindle down as well. So he actually looked at the historical U.S. data going back to the 1920s and looked at different 30-year periods, assuming a retirement might last up to 30 years. What percent could somebody withdraw and maintain that spending stream throughout their retirement without running out of money? And the answer from that historical data was, retiring in 1966, a hypothetical retiree with a portfolio of 50 to 75% stocks, which is actually pretty high. But that was what gave you the best shot at being able to sustain just over 4% as a spending rate over retirement. Now, in terms of why that may be different today, well, that study, it had a lot of simplifying assumptions because it was really bringing the discussion down from 8% to 4%.
Wow, that's a huge drop.
Right. And that was just adding in the realism. And the problem is, the reason why it's different is because when you're spending from a portfolio and the portfolio is losing value, so if you have a big market loss early in your retirement and you're still trying to spend the same amount, then your portfolio is digging a hole. You're having to withdraw an increasing percentage of whatever is left, that even when the overall market recovers, your portfolio has been depleted to a point that it's not able to enjoy that full recovery because you've been withdrawing from your portfolio. And that's why you can get stuck on this trajectory where even if the markets pick up and your average return, like the average return in the markets over your retirement was pretty decent, those negative returns early in retirement can cause your withdrawal rate to be much less. And that 4% was just from U.S. history. It didn't assume any kind of fees on the underlying investments. And also, the situation today really is that with interest rates so low, in the past, a diversified investment portfolio would have generally provided around at least 4% as interest and dividends. And that's not possible now. It heightens the sequence of returns risk. And we don't have a lot of examples in U.S. history except in the 1940s where interest rates were so low. So we really can't be confident that 4% is always going to work just because it worked in U.S. history.
Right, and with the volatility that we're seeing more so now, it makes it even more difficult. Okay, so it used to be 8%. So when it went down from 8%, let's say you had $1 million portfolio, you could take out, at least what people told you before this early in the 1990s, supposedly $80,000 a year to live on. That's pretty good. And then it was changed in the mid-90s or so, like you said, to 4%. So now people's income just got cut in half. They can only spend $40,000 a year out of their $1 million portfolio with minimal risk of running out of money. But now we're saying that 4% really isn't necessarily safe. So is there a new number that people can safely take out of their retirement and hope that they have a sense of confidence that they're not going to run out of money before they pass away?
Well, in some sense, this kind of question is a bit strange because it's hard to use an investment portfolio with volatility and maintain a safe spending stream from it. It's like theoretically impossible to do that. In terms of, in practice, I'm thinking 3% is looking to be a much safer number these days when you're talking about an investment portfolio with the 50 to 75% stocks. I think that's more realistic given the interest rate situation today.